Hey everybody, it's Mike Nelson from EfficientLending.net. First and foremost, thanks so much for checking out my content online. I really appreciate it. I know everybody's busy, so I'm always thankful when people spend time with me online. All right, topic for today. This is going to be a repost, a little bit of a redo from a topic I tried to tackle in June of 2017. And that topic is the importance of term versus interest rates. And it's obviously really important today just because of what's been going on in the market all across the country. When I'm talking to real estate agents and buyers, homeowners, people worried about rising home prices. Clearly everybody's seen interest rates going up, and I see just a lot of emotional connection, and rightly so, to what interest rates are at, because people are getting high 4s, low 5s on their 30-year fixed mortgages, and candidly, up until about a year and a half ago, everybody's used to 4% and whatnot. The other piece is I see a lot of turmoil in the market and discussion about, is the market correcting, is it softening? And first and foremost, we have to understand interest rates have risen, and it's a good thing that they have. Why? The rising interest rates have kept inflation at bay. Inflation is the worst thing that can happen in the market because prices will go so high that nobody can afford to sell, or they can't afford to buy as well. The other thing is, when I'm talking to buyers and homeowners, a lot of trepidation and it's just emotional connection to, I can't pay for a mortgage at 5%. I understand that. I get the emotional connection to that. But we also have to bring in the data sets that the existing homeowners, their equity has risen substantially in their homes. And then for both existing homeowners and buyers as well, wages have risen substantially as well. And so yes, rates have gone up, but the economy has improved as well, which is very important as we evaluate, should we buy or should we not buy. So that's why we're going to retackle this today, or I'm going to tackle this issue again. So I'm going to see if I can't demonstrate that term is a far more important metric to look at than actually an interest rate relative to the equity, i.e. how much home you're buying with a mortgage. And I'm going to use a mathematical example to do this, and so hopefully it'll make sense. Before I dive into the example, I just wanted to make sure everybody's on the same page with three terms that I'm using here. Number one is term. Term is the length of the mortgage. So it's a term is 15, 20, 25, 30 years. Pretty simple. The period is a amount of time within a mortgage. So for example, if we wanted to calculate how much interest has been spent or the principal balance remaining on a mortgage after 10 years, we would look at a period of time, namely 10 years. It's very important. I'll unpack that a little bit here in just a minute. And then the interest rate is obviously rate. It's just the interest rate on the loan. So why does this all matter? And I'm going to tell you, it's nuanced and it's not as obvious as one might think. And so we have to look at math. And I'll tell you, educational background, financial experience, it doesn't necessarily matter. I talk to people who have never bought a home before and they understand these concepts very quickly. I've talked to doctors and physicians with tons of educational background, and they're nuanced on it and they don't quite understand, or they're surprised by how the numbers go. So don't think this is obvious to everybody, because it's not. All right, jumping into my example. And the last thing before I do have to do a disclaimer. The interest rates that I'm using are not reflective of the market today or whatever day you are watching this video. So you can't call me and say, hey, I want those terms on the loans that you're showing in this example. Doesn't exist. The numbers I am using are only for this illustrative purpose, and I'm not trying to make the assertion that these interest rates exist today or at any time in the marketplace. Okay, here we go. Jumping into the example. First thing we're going to look at a hypothetical $250,000 loan, and I'm going to look at a term of 15 years, and I'm going to have a 6% interest rate. Okay? So you can see the monthly principal and interest on that is $2,109 and change, and the total interest you would pay if you took this loan to term is $129,735.58. Typically that surprises people. That is 51, almost 52% of the original principal balance of the loan in 15 years. All right, moving forward. Now what I'm going to do is say 20 years, And I'm going to even drop the interest rate a half a point. And let's see what happens. Is this a better deal or a worse deal in terms of total interest paid? All right, so let's look at it. Your monthly principal and interest is $1,719 a month, and your total interest paid is almost $163,000. That is 65% of the principal balance of the loan. Okay, keeping going on. Let's drop the interest rate another 5%, or half a point, I should say. 25-year loan, you can see the payment, and you can see that now it's the total interest paid at term is $188,442 and change. That's about 75% of the original $250,000 loan balance. And my last example is on the 30-year loan, 4.5% interest rate, and you can see that the total interest paid is $206,601.88. All right, here's what I've done. I've said, let's look at the 15-year loan, and that is the highest interest rate on my example by 1.5 because 30 years is 4.5 points. So in essence, if you look at the percentage change in payment of $2,109 at 15 years to $1,266 at 30 years, that's about a 40% decrease in your monthly payment. Okay? If you look at the interest paid between the 15 and the 30-year loan, it's almost a 60% increase in total interest paid. So in essence, your payment's going down 40%, but your interest has gone up 60%, and I'm even dropping the interest rate 1.5 points between 15 and 30 years. That's subtle, it's nuanced, but that's a big difference. Clearly, it's to the lender's investor's advantage to have you go to a longer term. The investor's even lowering the interest rate, but you're still not getting the full dollar-to-dollar reduction. 40% reduction in payment is yielding 60% interest. So that extra 15 years is costing you another 60% in the interest that you're paying. A couple things that are important to know about this. This trend holds true. Let me back up a step. The vast majority of Americans will retire their loan between 7 and 10 years, okay? And so what I want to say with this is that even if you retire your loan between 7 and 10 years, this trend, relationship of your reduction in payment to the longer term yielding a higher subsequent payment and interest, that holds even if you retire your loan between 7 and 10 years. Very important. Why? Because it means the shorter term you can pay for your mortgage, the faster you will gain equity in your home. And this is important because when you retire the loan, meaning you sell or refinance the house 7, 9, 10 years, and the vast majority of Americans do that, you will own more of your home when you retire it. And owning more of your home means that if you're selling your home 7, 8, 9, 10 years in, you're going to take more cash because you own more of it, you're selling more of it to the buyer. Or think about it, if you refinance your home or you do a cash out refinance, you're going to be able to get more cash out refinance downstream. Or if you're refinancing home, you're going to refinance a smaller principal balance, and that smaller principal balance may allow you to even shorten the terms of your loan even more, or you're just borrowing less and you're consequently paying less interest on your loan as well. I hope that makes sense, and I hope it's clear. Now, people will say, but Mike, the difference in payment on a 15-year loan is versus a 30-year loan, I just simply can't cash flow or pay that increased payment on a 15-year loan. I get it. So, two options. Look at the 25-year loan. If you use this example and you compare, I've already done the math, you compare the payment on a 25-year loan at 5%, $250,000, to a 30-year loan, 5%, $250,000. The 25-year loan is about $120 more a month payment. Okay, so some people can handle that, some people can't. But the other thing is this. Look at the purchase of your home as a long-term purchase, obviously. So maybe you have to do the 30-year today, but maybe 5 years down the road, your financial situation will be such that you can refinance the loan to a 20, 25, 30-year loan and take advantage of it. All right, I've jumped into a lot of topics today, a lot of math, a lot of numbers. It's subtle, it's nuanced, it can be really confusing. I really encourage you to send me a text, email, call me. I'm more than happy to chat through these scenarios with your personal situation. But I will tell you this, as you're evaluating getting into the market, purchasing, refinancing, selling your house, whatever it is, make sure you don't get overly emotionally connected to the rise in interest rates. Understand that there are different components to a loan that can help mitigate the effect of an increased interest rate in the marketplace today versus any number of years ago. All right, thanks again for your time. I really appreciate it. I hope you have a great week, and hopefully we'll talk to you soon.